Bad information leads to bad decisions. Every decision you take in your business is based upon some information or some data that you've got, even if it's gut feel. But how good is that information? Making bad financial decisions will stunt your growth at best, and at worst it could be catastrophic for your business. So here we have the 5 accounts disasters that could stunt the growth of your business. The first one is bad records. How do you know that you've got everything recorded? Are there any missing invoices, sales invoices, purchase invoices, receipts? A red flag that this is happening maybe is when a supplier phones you up chasing an old invoice that you haven't even got in your system. The next thing to know about is false claims. We all know it's really bad to make false claims about our business, but are you making false claims in the accounts for your business? You need to ensure that you're claiming for things that you can legitimately claim for and not claiming for the things you shouldn't be. That cup of coffee you bought your client the other day, did you claim for that? Because you should have done. Next we have using outdated software or no software at all. You wouldn't run a marathon in your slippers, but companies are doing this with their account software time and time again. Make sure you've got the right software to do the right job and it's up to date. Cheap imitations have their limitations. Using the wrong software will cause you a whole lot of pain in the long run. If you're out looking for software, think about your future plans, where you're going to be, not just what you need now. Will the software scale? Will it achieve what you need it to achieve in the future? Because you don't want to keep changing. Another great way to make sure your accounts are complete and accurate is to check them against other things, like reconciling to your bank account. If your bank account's not the same as your accounts records, something's wrong, don't ignore it. Finally, we have mixing and matching. What do we mean by mixing? We're talking about mixing personal items with business items, personal expenditure with business expenditure. Not always an easy thing to do. So think of it simply like this. Would you have spent that money if you weren't running your business? You had a meeting with your client in a coffee shop. You can claim for the coffee. You wouldn't have spent it if you weren't having a meeting with your client. But don't claim for your lunch, because you have to eat whether you're running a business or not. And what do we mean by matching? Matching is about getting things in the right months in your accounts. Just because you spent the money in that month doesn't mean it relates to that month. Don't mix up cash and profit. Take as an example your car insurance. Most of us pay for it once a year. You renew your car insurance on an annual basis and it pays for the whole 12 months. But just because you paid for it in one month doesn't mean that's the month it should be in your accounts. You need to spread it out over the whole year. Don't let your accounts become a nonsense. Use these points to improve the quality of your decisions.